Imagine a company that basically oversees $1 trillion.
Yeah, that's a massive number.
Right. Like we hear that word thrown around so much in finance, trillions this, trillions that it kind of loses its meaning.
It really does. It just becomes a concept.
But let's pause and actually think about that scale for a second. I mean, $1 trillion is roughly equivalent to the entire gross domestic product of a country like the Netherlands or Saudi Arabia.
Wow. Yeah, when you put it like that.
It's an ocean of capital. And you would assume a company managing a footprint that massive would be a total household name.
I would think so, yeah.
Like something you see advertised on billboards or, sponsoring sports stadiums. Yet, if you ask most people walking down the street, they've never even heard of Hamilton Lane.
No, probably not. I mean, it really is one of the most quietly influential entities in modern finance. Mm-hmm. They just don't need the billboards because historically their clients haven't been retail investors, walking in off the street. They're the architects for the absolute giants.
The heavy hitters.
The massive sovereign wealth funds, the state pension funds, those sprawling university endowments.
And that is exactly why we are looking at them today. So, welcome to a highly focused Talk Tickers edition of The Deep Dive.
Yeah, we've got a lot to cover.
We do. For those of you joining us, you are likely listening because you actively manage your own portfolio, or maybe you're tracking this massive shift of wealth into alternative assets.
Or you just, want to know where the smart institutional money is moving right now.
Exactly. So today we are tearing into Hamilton Lane's Q3 2026 earnings call. We've gone through the transcript from the co-CEO and the CFO, and our mission is simple.
Cut through the fluff.
Right. Filter out the corporate speak and deliver the absolute core of what this means for you as an investor.
Which is really vital because Hamilton Lane, they trade under the ticker HLNE. By the way, they act as a barometer for the entire private markets ecosystem.
They're like the plumbing, right?
Yeah, exactly. They provide the infrastructure, the data, and really the access for capital to flow into private equity, private credit, real estate infrastructure.
So when you understand their quarterly earnings, you're essentially reading the structural tectonic shifts of that broader alternative asset landscape.
You're seeing the whole board.
Okay, let's unpack this. Let's get right into the raw data because that $1 trillion figure I mentioned at the top, it's not a hypothetical.
Oh, it's very real.
Right. At the close of this quarter, their total asset footprint officially crossed that $1 trillion mark. That's a 6% increase year over year.
Yeah.
But as we know, not all assets are created equal on a balance sheet. Wall Street splits this footprint into two very different buckets.
Right, AUM and AUA. And those two buckets are the key to understanding how they actually, make their money.
So break that down for me. Start with AUM.
Sure. So AUM stands for Assets Under Management. This is the capital where Hamilton Lane has both hands firmly on the steering wheel.
They're driving.
Exactly. They are making the active discretionary investment decisions. They're, actively allocating that money into specialized funds, picking managers, or building these highly customized portfolios.
And because they are doing the heavy lifting, taking that active risk of management, they obviously charge a premium for it.
Precisely. Their fee-earning AUM reached $79.1 billion this quarter.
Wow.
Yeah, that's an 11% increase year over year. And if you look at their total AUM, which includes capital that's committed but hasn't started generating fees yet, it sits at $146 billion.
Up 8%, I think the transcript said.
Right. So this is really the high-octane engine of their revenue.
Okay, which leaves the other bucket, the AUA, or assets under advisement. And this is where the sheer scale of that $1 trillion footprint really comes from.
Oh, absolutely. AUA hit an astounding $871 billion.
That's just wild.
It is, up 6% year over year. But with AUA, Hamilton Lane isn't driving the car. The massive pension fund or whatever institutional client, they still hold the assets and make the final decisions.
So what is Hamilton Lane doing for that $871 billion?
They provide the navigation system. So proprietary data software, the back office reporting, risk analytics, and, strategic advisory service.
Ah, okay. It's essentially a toll road model.
Exactly.
They charge a much lower fee for AUA compared to AUM, but the margins must be incredible. I mean, providing software to a $10 billion portfolio doesn't cost 10 times as much as providing it to a $1 billion one.
No, it scales beautifully.
Right. And crossing that $1 trillion mark combined, it feels like a psychological tipping point. It proves their infrastructure is just deeply embedded in the global financial system.
It really does. But, holding assets is one thing. Monetizing them is another entirely.
Good point. Let's look at the actual revenue.
So the revenue metrics were just exceptionally strong. Total fee-related revenue came in at $507 million for the period.
Okay, so that's a 31% year-over-year growth rate.
Yeah. For a financial institution operating at this kind of scale, growing revenue by nearly a third in a single 12-month period is remarkable.
It is. And that brings us to a metric that private equity analysts just obsess over, right? FRE.
Oh, yeah. Fee-related earnings.
Yeah. When I first started looking at private equity firms years ago, I used to get so frustrated trying to model their earnings. Like one quarter, they'd report massive profits, and the next quarter, their earnings would just fall off a cliff.
Right, even though the business hadn't really changed.
Exactly. It drove me crazy.
Well, you were experiencing the volatility of what we call carried interest. Historically, a huge portion of the profit in private markets comes from performance fees.
Right.
So when a firm buys a company, holds it for 5 years, and then sells it for a massive gain, they take a percentage of that profit. It's highly lucrative, but it's incredibly lumpy.
Yeah, because you cannot reliably predict exactly which quarter a multi-billion-dollar merger is going to close, which is an absolute nightmare if you're a public market investor trying to value the stock based on like a predictable multiple. You want to know what the baseline floor is.
And that is exactly why the industry and Wall Street analysts shifted their focus so heavily toward FRE.
So FRE strips out the lumpiness.
Right. It isolates the steady, recurring, highly predictable cash flows of the business. You know, the management fees they charge on AUM, the advisory fees on the AUA, the software subscription revenues.
It shows you the actual metabolism of the day-to-day business.
It really does. And for Hamilton Lane, their year-to-date FRE hit $254.6 million.
Wow.
Yeah, that is a 37% jump year over year. So the recurring cash engine is not just growing, it's accelerating faster than the broader revenue base.
Okay, but let's talk about the efficiency of that growth, because the transcript highlighted something that blew my mind. The FRE margin expanded to 50%.
Up from 48% the prior year, yeah.
Yeah, right. And if you're an individual investor looking at your brokerage account, trying to decide if this business model is sound, that 50% margin is the smoking gun.
Oh, absolutely.
I mean, it means that for every new dollar of recurring management fees they bring in the door, 50 cents of it drops straight to the bottom line as earnings.
Yeah, that margin expansion proves out the scalability we were just talking about with their AUA and software platforms.
Right.
Once you build that core infrastructure, you know, the compliance teams, the proprietary risk software, the global offices adding the next $1 billion in assets, doesn't require you to double your headcount.
The fixed costs are already covered.
Exactly. So that incremental revenue is just incredibly profitable.
Let's translate this into the actual earnings per share, because the accounting here can get a little dense.
It definitely can.
So the company reported a GAAP EPS of $4.35, and that was based on $183 million in annual revenue. But then they immediately told investors to look at their non-GAAP EPS of $4.41.
Right, based on $240.1 million of adjusted net income.
Yeah. And I got to say, whenever a company tells me to ignore the standard accounting rules and look at their custom adjusted numbers, my defenses go up.
As they should.
So why is there a difference here? Like, why should we trust the non-GAAP number?
Well, it's a healthy skepticism to have. In a lot of industries, non-GAAP or adjusted earnings are just used to hide regular operational costs.
Exactly.
But in alternative asset management, GAAP generally accepted accounting principles. It often forces companies to include non-cash expenses that don't reflect the actual cash moving through the business.
Like what?
Well, for example, GAAP requires them to factor in non-cash stock-based compensation and really complex amortization from past acquisitions.
So it artificially depresses the appearance of their cash flow.
Yes. So the adjusted net income of $240.1 million and that non-GAAP EPS of $4.41, it strips out those non-cash accounting artifacts. It gives you a much clearer, transparent look at the actual cash generation power.
Okay. And I guess the ultimate proof that this adjusted number is real is how they treat their dividend, right? They declared a dividend of 54 cents per share this quarter.
Which is the critical signal. You can play games with accounting all day long, but you cannot fake a cash dividend.
You actually have to send the money.
Right. That 54-cent payout keeps them perfectly on track to hit their targeted $2.16 per share for fiscal 2026.
And that's a 10% increase from the prior year.
Exactly. And look, a management team does not commit to a double-digit dividend hike unless they have absolute ironclad confidence in the recurring nature of their cash flows.
Okay, I hear the bullishness. The trillion-dollar milestone, the 31% revenue growth, the 50% margin, the dividend hike. It all sounds great.
But it does.
But we need to stress test this. When I look at private market earnings, especially when the growth numbers look this flawless, I always worry about the sugar high effect of fund closures.
Yes.
Right. Like, are we looking at a permanent structural elevation in their business, or did they just recognize a massive windfall of backdated fees this quarter that won't be there tomorrow?
You are bringing up the concept of retro fees or catch-up fees. And honestly, it was a major point of discussion on the earnings call.
Good. So let's get into it.
It's one of the most misunderstood mechanics in private equity accounting.
Let's break down the actual mechanism of a retro fee so we really understand the risk here.
Okay, so when Hamilton Lane launches a massive new specialized fund, they don't just raise all the money on a single day.
Right.
The fundraising period can stay open for 12, sometimes even 18 months. So let's say they launch a fund in January. Institutional investors who commit capital in January start paying management fees from day one.
Makes sense.
But what happens if another massive pension fund decides to join the fund later, say, in November?
Well, if they just start paying fees in November, they essentially got a free ride for 11 months, while the early investors footed the bill for the team sourcing the deals.
Exactly. It wouldn't be fair. So to make it equitable, the industry uses retro fees. That investor joining in November has to pay backdated management fees as if they had been in the fund since January.
Oh, I see.
So for Hamilton Lane's accounting, this means that in the quarter when the fund finally holds its final close, they suddenly book a massive, concentrated lump sum of revenue.
Which makes that specific quarter look like an absolute blowout, but it artificially inflates the growth rate. Because the next quarter, that lump sum vanishes and revenue appears to drop.
Usually.
So applying that to this Q3 2026 transcript, were these blowout numbers driven by a massive wave of retro fees?
The exact opposite, actually.
Really?
Yeah, and this is where the underlying strength of the quarter really shines through. The CFO addresses directly. He noted that their specialized fund revenue grew by 15% year over year, but it achieved that growth despite facing a massive headwind from retro fees.
Okay, what were the actual numbers there?
In the prior year period, Hamilton Lane booked nearly $21 million in retro fees, largely driven by the final close of their sixth secondary fund. It was a massive sugar high.
Okay.
But in this current quarter, they only recognized $2 million in retro fees.
Whoa. That is a staggering detail. So they essentially started the quarter in a $19 million hole compared to last year.
Exactly.
They had to replace $19 million of one-time catch-up revenue, and they still managed to grow their overall specialized fund revenue by 15%.
Yes. What that actually means on the ground is that the core organic growth of their fee-earning asset base is compounding at a much, much faster rate than that headline 15% figure suggests.
Wow.
If you normalize the data, strip out the retro fee noise from both periods, the underlying momentum of the business is incredibly aggressive. The sugar high is gone, and the actual muscle mass of the business is carrying the weight.
That's fascinating. So if the raw organic growth is that powerful, it begs the question of where that capital is actually flowing. Like, what is the structural engine driving this?
Right.
And looking at the transcript, this is where the narrative shifts from simply gathering more assets to a fundamental evolution in what kind of assets Hamilton Lane is managing.
This brings us to probably the most critical strategic pivot in the company's recent history, the shift toward Evergreen funds.
Yeah, this came up a lot.
To understand why this is so transformative, you have to look at how their fee structures have evolved over time.
Well, the blended fee rate jumped out immediately to me. This is the average fee they charge across their entire asset base, right?
Correct.
The transcript states their blended fee rate is now 67 basis points. For context, for you listening, a basis point is 0.01%. So they are effectively charging 0.67% on the massive pools of capital they manage.
Right.
But what is fascinating is a historical comparison. When Hamilton Lane went public back in 2017, their blended fee rate was 57 basis points.
Which completely defies the gravity of the broader financial industry.
Yeah. Over the last decade, we've watched Vanguard, BlackRock, and that entire passive index fund revolution drive public market fees in a race to the bottom.
Yeah, retail investors pay essentially zero fees to hold an S&P 500 index fund today.
Exactly. Yet, Over that exact same time frame, Hamilton Lane has actually expanded its average fee rate by 10 full basis points. How do you increase your pricing power in an era of fee compression?
You do it by fundamentally changing the product mix.
Okay.
So in 2017, the bulk of their fee-earning AUM, about 67% of it, actually was tied up in customized separate accounts.
What are those?
These are bespoke, highly tailored portfolios built for massive single clients, like a specific state pension. Because of the sheer scale of the capital involved, those clients demand heavy fee discounts.
Volume discount.
Right. Customized accounts are great for stable AUM, but they're low margin. Only 33% of their business was in specialized funds back then.
And today?
The ratio has completely flipped. Customized separate accounts are down to 52% of the mix, and specialized funds, which carry significantly higher fee rates, have surged to 48%.
Wow.
And the absolute vanguard of that specialized fund growth is the Evergreen platform.
Let's dig deep into this Evergreen concept because it absolutely dominates the transcript. The numbers are undeniable. Evergreen funds brought in $1.2 billion in net inflows just in this quarter alone.
Just this quarter.
That pushed their total Evergreen AUM over $16 billion, representing a massive 70% year-over-year growth rate. For an investor trying to understand why capital is flocking to this specific structure, we need to contrast it against how private equity has traditionally operated.
Okay, yeah. So traditional private equity is built on what is known as a closed-end or drawdown structure. Let's say Hamilton Lane wants to launch a $2 billion buyout fund. They go out to investors, secure the commitments, and then they lock the doors.
The fund is closed.
The fund is closed. But if you commit $10 million as an investor, you don't actually wire them $10 million on day one.
Right, because they haven't found the companies to buy yet. If they took all your cash on day one and it just sat in a bank account for 2 years while they shopped for deals, your overall return on investment would be terrible.
Right. It would just drag down the internal rate of return.
Makes sense.
Exactly.
Right.
So this creates the dreaded capital call. You pledge the $10 million and you wait. 6 months later, Hamilton Lane finds a software company to buy and they issue a capital call. Wire us $2 million by Thursday. A year later, they find a manufacturing company. Wire us another $3 million.
Oh, man. If I'm a portfolio manager or a wealth advisor handling money for a high net worth individual, that sounds like an absolute logistical nightmare.
It is.
I have to keep that client's cash sitting in a liquid, low-yielding account for years, just waiting for the phone to ring. I can't invest it elsewhere because I need to be ready to wire it on a few days' notice.
It is deeply inefficient.
Yeah.
And it creates what the industry calls the J-curve.
The J-curve.
Yeah. In the early years of a drawdown fund, your returns are actually negative because you're paying management fees, but the underlying companies haven't had time to grow and be sold for a profit.
Okay.
Then, years later, when they finally start selling companies, the returns shoot up, creating the shape of a J.
Got it.
Finally, they distribute the cash back to you, often in unpredictable lump sums. You never really know exactly how much of your money is actively working at any given moment.
So how does an evergreen fund solve this structural friction?
An evergreen fund, which is also sometimes referred to as a semi-liquid fund, operates much closer to how a mutual fund works. The fund is continuously open.
Oh, nice.
Yeah. If you want to allocate $10 million this month, you wire the money and it is immediately put to work. There are no capital calls. You gain instant, fully funded exposure to a massive pre-existing portfolio of private market assets.
You essentially bypass the negative drop of the J-curve because the portfolio is already mature and cash flowing.
Yes. And even more crucially for the wealth management channel, evergreen funds offer periodic liquidity. Usually on a monthly or quarterly basis, they provide a window where investors can request to redeem some of their shares and take their cash out based on the current net asset value of the fund.
I completely understand why the retail channel, wealth advisors, family offices, mom and pop millionaires would demand evergreen structures. They hate the complexity of capital calls and they want some semblance of liquidity.
Definitely.
But looking at the Q&A portion of the call, an analyst asked a really fascinating question about institutional demand. We are seeing massive, sophisticated entities like sovereign wealth funds pouring money into evergreen funds. Why? Institutions have the back office staff to handle capital calls, and they have the long-term time horizon to handle illiquidity. What's the draw for them?
That's a brilliant question, and it really challenges the consensus assumption. The co-CEO jumped in to clarify this directly. He stated that for institutional giants, liquidity is actually not the primary driver for utilizing evergreen funds.
Wait, really?
Yeah, they are buying them because they're terrified of having their capital locked up.
So what is the utility for a multi-billion-dollar pension fund?
It comes down to two strategic advantages. First is the sheer ease of use. Even if you have the staff to manage capital calls, it's still an administrative burden. Being fully deployed on day one is simply more efficient. But the second, and far more powerful reason, is tactical asset allocation.
Okay, this is where we get into the actual maneuvering of the capital. Walk me through a scenario.
Let's say you're the chief investment officer of a massive state pension fund. You're analyzing the macroeconomic landscape. You see that inflation is sticky, central banks are signaling that interest rates will remain higher for longer, and traditional banks are pulling back from lending.
Okay, I'm with you.
You make a strategic decision. I need to heavily overweight my portfolio in senior secured private credit to capture these high yields, and I need to do it right now.
Right. But if that CIO tries to execute that tactical shift using traditional drawdown funds, they run into a brick wall. They have to go out, interview managers, commit to a new credit fund, and then wait. It might take 2, 3, or even 4 years for the manager to actually call all that capital and deploy it into loans. By the time the money is actually working in the private credit market, the macroeconomic cycle has likely completely changed. The opportunity passed.
That is the exact limitation of the traditional model. It turns institutional private market portfolios into slow-moving battleships. You cannot turn them quickly.
Right.
But with an evergreen fund, that limitation vanishes. Because the fund is continuously active and already fully deployed, that same CIO can instantly wire $500 million into Hamilton Lane's Senior Credit Opportunities Evergreen Fund. On day one, that capital is fully at work, generating yield, and the CIO has successfully executed an immediate tactical overweight.
They turned the battleship into a highly maneuverable speedboat.
That's a great way to put it.
Yeah.
And that speed of deployment is why the transcript noted that Hamilton Lane's International Credit Evergreen Fund averaged over $90 million in net inflows every single month throughout all of 2025. Institutions are using these vehicles to make rapid strategic adjustments to their massive portfolios.
It's a fundamental rewiring of how institutional money moves. But Evergreen isn't the only structural catalyst driving Hamilton Lane's AUA and revenue growth. We have to address the elephant in the room. The Guardian Life partnership.
Oh yeah, this partnership is a masterclass in how alternative asset managers are evolving into outsourced chief investment officers.
The strategic agreement officially closed during this period, right?
Right. Hamilton Lane is now taking over the active oversight and management of nearly $5 billion of Guardian's existing private equity portfolio.
So that $5 billion immediately shifts into Hamilton Lane's assets under advisement next quarter. But taking over an existing portfolio is just the baseline. The absolute golden metric for a shareholder looking at this deal is the forward commitment. Guardian didn't just hand over their past investments, they committed to feeding the machine going forward.
Yes, they committed $500 million annually to Hamilton Lane's platform for the next 10 years.
10 years. I mean, in a financial market obsessed with quarterly earning cycles, locking in a decade of guaranteed capital flow is almost unheard of.
It's incredibly rare.
Wall Street assigns the highest valuation multiples to businesses that can prove long-term revenue visibility. Hamilton Lane essentially just signed a decade-long ironclad subscription agreement with a whale client.
And we've connected this back to our earlier discussion on the structural shift. Look at exactly where that Guardian capital is mandated to go. Of that $500 million annual commitment, $250 million is contractually guaranteed to flow directly into Hamilton Lane's Evergreen platform.
So it serves as a massive, predictable base load engine for the very products that carry their highest fee rates.
Exactly.
The transcript noted that the initial economic impacts of this partnership, the actual revenue hitting the income statement, are going to start showing up next quarter in fiscal Q4 of 2026.
Right.
But I did notice one detail that usually spooks retail investors. Guardian received an equity warrant package as part of the deal. Does that mean current shareholders are getting heavily diluted to pay for this partnership?
No, the CFO front-ran that concern on the call. He clarified that the warrant package is structured to result in less than 1% dilution to existing shareholders.
Less than 1% dilution in exchange for $5 billion in immediate AUA and a guaranteed $5 billion in forward flows over the next decade. That is a phenomenal alignment of interests.
It really demonstrates their leverage in the market. They have the infrastructure that massive insurers desperately need to navigate the complexities of private markets.
Okay, this brings me to a detail buried a bit deeper in the transcript, but it might be the most fascinating indicator of where this entire industry is headed. Hamilton Lane didn't just gather assets this quarter. They deployed their own balance sheet capital to make a strategic investment in a tech company called Pluto Financial Technologies.
Yeah, this is huge.
They did this alongside Apollo, which is another titan of the alternative asset space. What exactly is Pluto, and why is Hamilton Lane using its own cash to back it?
To understand Pluto, you have to understand the final frontier of private markets. True liquidity. We've talked about how evergreen funds offer periodic liquidity, maybe a window once a month to redeem shares, but it is still restricted.
Right.
If you're a wealthy individual with a few $1 million locked up in a traditional 10-year drawdown fund, and you suddenly experience a life event, you want to buy a business, or you face a massive tax bill, you cannot access that capital.
Your money is essentially trapped in the fund until the manager decides to sell the underlying companies. Historically, the only way out was to find a buyer on the secondary market who was willing to take over your position. And because you were a forced seller in need of immediate cash, those secondary buyers would demand a punishing discount.
Exactly.
You might have to sell your stake for 70 cents on the dollar. It was draconian.
And that illiquidity trap is the #1 reason why financial advisors have been terrified to allocate their clients' wealth into private equity. Pluto Financial Technologies is operating at the absolute bleeding edge of solving this.
How so?
They're building a proprietary AI-driven technology infrastructure that connects directly into the underlying, highly complex data of private market portfolios.
So they are digitizing the actual performance data of these illiquid assets in real time.
Yes. And by establishing that real-time visibility and valuation, Pluto allows investors to essentially borrow against their private market holdings.
Oh, wow.
It creates a mechanism to extract liquidity to get cash without being forced to execute a fire sale of the actual underlying assets.
That is revolutionary for the wealth management space. It essentially allows an individual investor to treat a private equity portfolio the way they might treat a margin account in the public stock market. You maintain your long-term exposure to the high-growth private assets, but you gain a flexible line of credit against them.
Yeah, exactly.
The co-CEO's quote on the call really captured the strategy here. He said, "Continuing to improve the liquidity experience for individuals in a thoughtful, risk-aware way is one of the keys to deeper penetration of private markets in the wealth channel."
Hamilton Lane realizes that the multi-trillion-dollar pool of retail wealth will not fully unlock until the experience of holding private equity feels remarkably similar to the experience of holding a public mutual fund.
Bingo.
By taking an equity stake in Pluto, Hamilton Lane isn't just watching the technological disruption happen, they are actively building and owning the plumbing that will facilitate it.
It secures their position at the vanguard of the democratization of private assets.
So if we step back, we have a clear picture of the engines driving the present reality. The rapid expansion of evergreen funds eliminating the friction of capital calls, the Guardian Life partnership locking in a decade of structural AUA growth, and the strategic investment in Pluto building the liquidity infrastructure of the future. The underlying numbers are incredibly strong.
Very strong.
But of course, past performance does not guarantee future results. We need to look forward. Let's shift to the third pillar of our analysis: management guidance and outlook. During the Q&A portion of the earnings call, analysts pressed the leadership team on what the next 12 to 18 months actually look like. What is the immediate horizon for their fundraising pipeline?
Well, for an alternative asset manager, the fundraising pipeline is the ultimate leading indicator of future revenue. And Hamilton Lane is staging for a massive influx of capital in Q2 2026.
Okay, what are they launching?
The leadership team explicitly pointed to 2 massive products that are aiming for their first closes in that quarter: their 7th secondary fund and their 2nd venture access fund.
The secondary fund is the one that really demands attention. To put the scale of this upcoming launch into perspective, their previous secondary fund, Fund 6, raised $5.6 billion. That was a 40% jump from the fund before it. So the expectations for Fund 6 are sky high.
Yeah, they are.
But during the call, the co-CEO made a tactical comment that stood out to me. He went out of his way to explicitly remind the analysts that despite raising multi-billion-dollar vehicles, Hamilton Lane is still not the largest player in the secondary space.
Right, he did point that out.
Some of their mega-cap competitors are out there closing $25 billion or $30 billion secondary funds. Why would a CEO voluntarily highlight that they aren't the biggest shark in the ocean? Wall Street usually demands dominance.
He was answering a deeper, unasked question about market saturation. When a company grows its flagship fund by 40%, analysts inevitably start asking, have you hit the ceiling? Is the market tapped out? By pointing to competitors raising $30 billion funds, he's effectively outlining the massive runway that still exists for Hamilton Lane. He is telling investors, look at our explosive growth and realize we haven't even begun to bump our heads on the limits of this market.
He is highlighting a sheer total addressable market of the secondary space. And if you look at the mechanics of the secondary market right now, it is incredibly favorable for a buyer with fresh capital. We just talked about the illiquidity trap. There are hundreds of billions of dollars tied up in older private equity funds.
Tons of capital stuck.
You have institutional investors' pension funds that maybe need to rebalance their portfolios because of the denominator effect, or who simply need cash to pay out retirees who are desperate to sell their stakes in these older funds. But there is a massive supply-demand imbalance. There are far more people wanting to sell stakes than there are dedicated secondary funds with the capital to buy them.
Which creates a buyer's market. When capital is scarce, buyers like Hamilton Lane get to dictate terms. They can acquire highly mature, cash-flowing private equity portfolios at highly attractive discounts to their net asset value.
Right.
They are raising Fund 7 into one of the most target-rich environments in the history of the secondary market.
So the pipeline for getting money in looks robust. But what about getting money out? The entire private equity model relies on eventual exits. During the Q&A, an analyst from Morgan Stanley honed in on this.
Yes, the exit environment.
2024 and 2025 were notoriously brutal years for private equity exits. The IPO window slammed shut, and high interest rates killed the M&A market because debt was too expensive to finance big corporate buyouts. If private equity funds can't sell their underlying companies, they can't distribute profits back to their investors. When does the logjam break?
The tone from the co-CEO on the exit environment was surprisingly decisive. He did not hedge. He predicted that 2026 will be a significantly stronger exit environment than 2025.
Is that prediction based on fundamental data, or is it just the necessary optimism of a CEO hoping the Federal Reserve cuts rates?
He grounded the prediction in two very specific market mechanics. First, he highlighted the capitulation on pricing. For the last 2 years, the market has been frozen in a standoff.
Staring contest.
It's exactly. Sellers, the private equity firms, holding the companies were stubbornly anchoring to the euphoric, sky-high valuations of 2021. They refused to sell at a discount. Buyers, on the other hand, recognized that the cost of capital had changed and demanded lower prices. The bid-ask spread was too wide, so nobody transacted.
And he thinks that's over.
He noted that reality has finally set in. Sellers have accepted that 2021 multiples are not coming back, and buyers have accepted that interest rates are stabilizing. The expectations have finally aligned, allowing the gears of M&A to start turning again.
But his second point on exits is the one that really exposes the structural pressure inside the industry. It's about the ticking clock of the vintage years.
Yes, the vintage years.
The term vintage simply refers to the year a specific private equity fund was launched and began deploying its capital. The traditional playbook for a buyout firm is to acquire a company, spend 4 to 6 years improving its operations, increasing its margins, and growing its revenue, and then sell it.
Right. They aren't meant to hold these businesses forever.
Exactly. Because the exit market was essentially frozen for the last couple of years, there is now a massive backlog of highly mature companies sitting in funds from the 2018, 2019, and 2020 vintages. These companies are in their 5th, 6th, or 7th year of ownership.
It's a huge backlog.
The operational work has been completed. The value has been created. The private equity managers are facing immense pressure from their own investors, the limited partners, to finally harvest those profits and return the cash. The pressure to sell is outweighing the desire to hold out for a perfect price.
The dam has to break. And when it does, it triggers a massive wave of distributions, which ultimately feeds more capital back into the ecosystem for firms like Hamilton Lane to manage.
But while the overall exit environment looks promising, there was one specific micropanic that an analyst from Goldman Sachs brought up during the Q&A, and this is perhaps the most fascinating philosophical debate happening in finance right now: the AI software panic.
Oh man, it is a massive overhang on the entire tech sector.
Private equity absolutely loves enterprise software companies. For the last decade, buyout firms have gorged on software as a service businesses because they offer incredible recurring revenue, high gross margins, and sticky customer bases.
Exactly.
But suddenly, with the explosion of generative AI, there's a terror spreading through the market. The fear is that these legacy software companies The boring, steady businesses that private equity firms paid billions of dollars for are going to be rendered obsolete overnight by a wave of nimble AI startups.
Yep, that's the fear.
The Goldman Sachs analyst directly pressed Hamilton Lane on their exposure to this risk. How did management defend their portfolio?
The co-CEO dismantled the panic methodically. He started by addressing the structural defense, diversification. He reminded the analyst that Hamilton Lane is not a concentrated buyout shop taking 100% ownership risk on a single legacy software platform.
Right.
Through their direct investments, their co-investments, and their massive secondary portfolios, they hold diversified positions across hundreds of underlying funds and literally thousands of individual companies.
They own the index of private markets, essentially. If one specific software company gets wiped out by an AI competitor, it is a rounding error in a trillion-dollar footprint.
Exactly. But he didn't just hide behind diversification. He went on the offensive and attacked the core premise of the AI panic itself. He acknowledged that, yes, some legacy software companies that were acquired at peak valuations before the AI boom will struggle to justify their multiples.
Sure.
But he vehemently rejected the apocalyptic narrative that AI startups are going to vaporize the legacy enterprise software industry.
This is where we get into the mechanics of how technology actually scales in the real world. What was his counter thesis?
His thesis revolves around distribution. He predicts we're on the verge of a massive wave of targeted M&A activity. An AI startup in Silicon Valley might build a miraculous, revolutionary new large language model or automation tool. But what does a startup with 50 engineers desperately lack?
Trust, enterprise security compliance, and most importantly, tens of thousands of deeply entrenched corporate customers.
Precisely. And what do the boring legacy old tech software companies possess? They have the massive, sticky, established customer bases. They have the global sales teams. They have the deep integration into the daily workflows of Fortune 500 companies.
So it's a marriage.
Yes. His argument is that the AI startups won't destroy the legacy companies, they will be absorbed by them. We will see the new technology merge with the old distribution networks. The legacy platforms will acquire the AI innovators to deliver those cutting-edge solutions directly to their captive audiences.
I love the mechanics of that argument. It reminds me of the auto industry. You can sit in a garage and invent the most efficient, revolutionary electric motor in human history. But if Ford and Toyota own every single dealership, supply chain, and service center on the planet, you aren't going to bankrupt Ford. You're going to sell your motor to Ford, and they will put it in their trucks. The distribution network is the ultimate moat.
And he used this moment to make a broader philosophical point about how markets overreact. He compared the current panic over AI software disruption to the headlines we saw 6 months ago about defaults in the private credit market.
Oh, right.
When interest rates spiked, a few highly levered companies defaulted on their private credit loans. The financial media immediately extrapolated those isolated incidents into a narrative that the entire multi-trillion-dollar private credit asset class was toxic and on the verge of collapse.
Which, of course, didn't happen. The asset class performed incredibly well because the vast majority of loans were sound. The market always takes a microscopic issue and paints the entire macroeconomic canvas with it.
And Hamilton Lane's ultimate defense against both AI disruption and macroeconomic shocks is the sheer granularity of their underwriting. When they commit capital to a secondary portfolio, they aren't blindly buying a broad thematic trend.
They're digging in.
They deploy an army of analysts to conduct bottom-up asset-by-asset diligence. They're individually stress testing the cash flows and the competitive moats of every single underlying company.
They are essentially acting as the immune system for the portfolio. And that granular diligence is exactly what institutional clients are paying those 67 basis points for.
Exactly.
Okay. We have covered immense ground today. We have analyzed the raw scale of the trillion-dollar milestone and the efficiency of the 50% FRE margin. We have unpacked the strategic evolution of the business, how the high-fee evergreen structures are eliminating the J-curve, how the Guardian Life partnership secures a decade of baseline revenue, and how the Pluto investment positions them for the future of secondary liquidity.
We hit all the bases.
We've also looked forward at the massive Q2 fundraising pipeline, the unfreezing of the exit environment, and their defense against the AI software panic. Now we arrive at the most crucial part of the deep dive. We need to synthesize all of this data, strategy, and commentary into an actionable bottom line for you, the investor listening to this right now. Based on the underlying structural health of the business and the strategic pivots we've discussed, what is the definitive verdict?
When you look past the noise of the accounting artifacts and focus purely on the cash-generating mechanics of the business, the verdict is decisively bullish. Hamilton Lane is executing flawlessly on a long-term structural evolution that the broader market has perhaps not fully priced in.
Let's break that down into specific actions depending on where the listener sits. First, let's address the investor who already holds HL&E in their portfolio. If you own the stock today, what is your primary takeaway?
If you are holding the stock, your sleep-at-night metric is the dividend sustainability. The board just hiked the dividend by 10%, putting them on track for a $2.16 payout for the fiscal year.
Right.
But a dividend is only a promise. The cash flow is the reality. Your confidence as a shareholder should stem from the fact that this payout is supported by a highly efficient, expanding 50% FRE margin.
And the Guardian baseline.
Yes. Even more powerfully, the floor underneath your investment is backstopped by the Guardian Life Partnership. Knowing that $500 million of recurring capital flows will enter the system every single year for the next decade provides a level of downside protection that is incredibly rare in the financial sector. Hold the position and collect the compounding yield.
And what if you don't own the stock? If you're a prospective buyer looking at the financial sector, weighing Hamilton Lane against other asset managers or traditional banks, what should you be watching?
If you are considering initiating a position, your focus needs to be on the execution of their Q2 2026 pipeline. Watch the headline numbers on the final close of that seventh secondary fund. If they blow past the $5.6 billion size of their prior fund, it validates their massive runway thesis.
Okay.
But beyond the immediate quarter, you need to recognize the larger macroeconomic trend that Hamilton Lane is capturing. We are witnessing the great democratization of alternative assets.
The pivot from exclusively serving institutional giants to capturing the multi-trillion-dollar ocean of retail wealth. The mom-and-pop millionaires, the family offices, the independent wealth advisors.
Yes. For decades, retail capital was locked out of the outsized returns of private markets due to the friction of capital calls and the terror of absolute illiquidity. By aggressively scaling their Evergreen products, which operate with mutual fund-like simplicity, and by investing balance sheet capital into liquidity infrastructure platforms like Pluto, Hamilton Lane is systematically destroying the barriers to entry.
They are positioning themselves as the premier proxy for retail investors looking to access the private economy.
Absolutely.
They are essentially turning the exclusive velvet rope country club of institutional private equity into a highly profitable, endlessly scalable, recurring revenue subscription service. The business model is transitioning from lumpy and unpredictable to smooth and inevitable.
That is the exact thesis. They are a high-margin toll road sitting directly in the path of a massive demographic wealth shift.
As we bring this deep dive to a close, I want to leave you, the listener, with a final lingering thought. We've spent the last hour praising Hamilton Lane for breaking down the walls of private equity. We've talked about how Evergreen structures and Pluto's AI technology are bringing stock market-like liquidity to private, illiquid assets. They are democratizing access.
Which is a huge win.
It is. But there is a foundational paradox at the heart of this entire industry. The historical premise of private market outperformance, the very reason private equity has historically beaten the S&P 500, is largely attributed to what academics call the illiquidity premium.
Right.
The fundamental theory is that because your money is locked in a vault for 10 years and you cannot panic sell during a recession, the manager has the breathing room to fundamentally restructure the business. And because you endure that lack of liquidity, you must be compensated with higher returns.
It is the first law of thermodynamics for alternative investments. Illiquidity is the price you pay for alpha.
So, as you look at your own portfolio, and as you watch titans like Hamilton Lane successfully engineer liquidity into the private markets, you have to ask yourself a terrifying question. If private markets eventually become just as liquid, just as transparent, and just as easily traded on a smartphone app as public stocks, does that famous illiquidity premium eventually vanish?
That's the billion-dollar question.
By democratizing access to the alpha, are we fundamentally destroying the friction that actually created the alpha in the first place? It is a paradox that will define the next decade of modern finance. Something to keep in mind the next time you review your asset allocation. Stay curious, look past the headline numbers, and keep questioning the consensus. Thank you for joining us on The Deep Dive. We'll see you next time.